Ladies and gentlemen, welcome back to Crypto Boulevard. In this episode, we're going to take a look at different options to stake your money in stablecoins, get a passive income stream, and hopefully get rich over time. First and foremost, this is not financial advice. Always do your own research and wear big boy pants when investing in crypto. With that being said, let's dive in. Now, it is important to know that there are several risks when you are staking money. Basically, when you stake a coin, you are lending out your money to a third party and you will get interest back over time. That third party will use your money to make money for themselves. So if they don't make a profit, you're in trouble. Sometimes there can be a lock of your funds for a period of time. So if you want your money back, it can take up a few days or even a few weeks before the money is back in your wallet. Then there might be issues of insurance. Not every platform in this video will be insured. So if all the money disappears, basically you're effed. So always do your research concerning insurance before you start. And then there are inflation risks to account for as well. You could be making, for example, 10% interest in a year, but with all the money being printed by the government and by banks, your total money could be worth 10% less over time. So these are the things to keep in mind before you ape in. Now, if you're still interested after these warnings, let's take a look at all of the possibilities. So the first platform that I would like to talk about is Abit. Now, I have to start with saying that the full platform is not live yet. There is currently a light version of that app available and you can join the waitlist on abit.io. But Abit is changing the way of asset management by what they call Abitization. On their digital platform, not only could you invest in cryptocurrencies, but also in stocks, bonds, and commodities like gold, Tesla stock, or Netflix stock. You will not get the real Apple stock, but you will get a synthetic version of it, which price will mirror the real world stock. Now, when a synthetic asset is bought on the platform, there is of course a transaction fee. 80% of that transaction fee will be redistributed to all of the holders of that product. So they give an example of gold. Let's say you buy 1 ounce of gold and you keep it for 10, 20 or 100 years. The only thing that will fluctuate is the price of that asset. But when you buy, as they call it, Abitized gold, not only will you have your 1 ounce of gold, but you will also get a portion of the redistributed fees in the form of that gold. So not only could the price of gold go up in 10 years, but also the amount of gold that you have in your portfolio, the more the people trade gold on Abit. This is possible due to blockchain automation, and the automated redistribution of fees is what they call Abitization. Now, apart from these traditional assets, Abit is launching very soon a product that they call superchargers. These products will be Bitcoin, Ethereum, Binance Coin, US dollar, and Eurosmith, and you can stake them with an insane fixed APY. My particular interest goes to a 43 annual percentage yield on USD stablecoin. This means that if you stake $100,000 on their platform, after 1 year you will get $143,000 in return, which is insane and only possible in crypto land. Now, of course, if something sounds too good to be true, it usually is. So is this 43% sustainable? Abit has a few sources of income. For one, they hold Abitized products as well. So with every trade on the platform, their portfolio grows as well. A bigger source of income is their licensed quant trading tech. Trading groups can use these strategies to trade as part of a virtual hedge fund. Quantitative trading relies on mathematical computations and automated trading models to look for the best trading opportunities. So these licensed strategies can earn up to 40 to 50% returns per year. A majority of these revenues will go back to the users, whereas the rest is there to fund operations. Now, whether this method can survive a 3-year-long bear market remains to be seen. Abit does not give any long-term guarantee on these rewards, and the APY can be lowered or even removed, although that's not what they expect in the short to medium term. In case something bad happens, Abit would cease the trading in one or more of the supercharger products, and users will be able to transfer or withdraw their money. There is one condition though: when you want to stake your money in one of the supercharger products, you would have to match your total holdings with 25% of that value in free wave tokens. So if you own $1,000 in one of the supercharger products, you would also have to have $250 worth of freeway tokens to get all of the fixed APY. This will create, of course, huge demand for the freeway token, so it might be an interesting token to hold as well, since I do think that the big money will flow in to get the highest yield in decentralized land. Soon, for every $1 million that flows to the supercharger products, $250,000 worth of freeway tokens will be locked up. You do the math. Now, the second platform that I would like to talk about is my personal favorite, staking the Terra stablecoin with the use of the Anchor protocol, which will give you 20% return per year. Terra has built an entire ecosystem with features like the Anchor protocol, the Mirror protocol, a payments network, a stablecoin, and a native token, Luna. Now, you can make an entire video on all of the features of the Terra ecosystem, but for this staking video, we will only look at the Anchor protocol and their stablecoin UST. These Terra USD coins are linked to the Luna tokens, so if you have one USD, you can trade it in for $1 worth of Luna. If, for example, the price of one USD lowers to, for example, 97 cents, people will buy up these cheaper UST tokens and swap them out for $1 of Luna and making a profit. This buying pressure keeps the price of their stablecoin around $1. Now, to get 20% APY in the Anchor protocol, you would have to stake UST. If you start, for example, with $10,000 and you would reinvest your interest every year, you would end up with $60,000 after 10 years. And if you would leave it for 30 years, it would even go up to $2.5 million. If the Terra ecosystem and their fixed 20% return is still there, of course. So where does this 20% return come from? Now, the Terra mechanics are quite complicated, but I will try to keep it simple. Basically, Anchor lends out money to borrowers as well. Through interest rates on the borrowed money and the collateral that you would have to put up, Anchor earns about 22% annual interest. 20% goes to pay out people that stake their money on the Anchor protocol, while 2% will go into yield reserve. This is a buffer for when there is low borrowing demand. Terra is working on an insurance protocol, so in case anything bad happens, all the funds are safe, and I think that when that insurance is there, this ecosystem will grow even bigger than it already is. The last platform that I would like to cover is, of course, BlockFi. This is kind of like a crypto bank where you can borrow and earn on your cryptocurrency. When you open up a BlockFi interest account, you could earn up to 9.3% interest on your USDT. Now, the reason why I personally like BlockFi is that they are founded in 2017 and they are still standing, which means that they have survived one bear market already. For the newer crypto banks, it remains to be seen if they can survive another bear market. According to their website, BlockFi works within the regulations on federal and state level in the US. Apart from that, they are backed by the biggest investors in crypto space, like for example the Winklevoss brothers. Now, also with BlockFi, they are able to pay out these insane percentages to account holders because they charge higher interest rates on the lending side. As long as they capture more from what they collect than what they pay out, they should remain profitable. Now, as always, there are risks. In their terms of service, it states that withdrawing can be suspended if the platform is, for example, overwhelmed by traffic. Now, for your USDT account, it might not matter that much, but it is very inconvenient and it can be dramatic if you hold Bitcoin or Ethereum there. BlockFi could also decrease rates to stay profitable. They have done it before with Bitcoin and Ethereum for larger holdings. And lastly, your funds are not insured, so know what you're dealing with and know the risks before you lend out your hard-earned money. Now, other notable mentions are, for example, Celsius Network, where you can get rewards in the tokens that you stake. So stake US dollar and get US dollar, or you can stake US dollar and get rewarded in Celsius tokens. There is YieldApp, where you can get, for example, 10% APY on USDT, and on top of that, you would get 2 to 10% returns in their native token YLD. There are, of course, other platforms like PancakeSwap, where you can get phenomenal returns of around 100%. So this means that you can double up your tokens in 1 year. A disadvantage of this is that it's not in stablecoins, so you might be doubling up on something that has the potential of losing 50 50% of its value due to inflation or a bear market. This is of course the reason why I chose stablecoins to stake in this video, but the same can be said about the US dollar. With the Fed printing so much money for stimulus funds these days, there will be inflation and your dollar might be worth less and less and less over time. So let me know in the comments what you think of staking stablecoins. If you want to see more crypto videos, please hit that subscribe button, hit that like button, and I will see everybody in the next vid. I'm out. Peace.